Hello, everybody, and welcome to Investing with IBD podcast, sponsored by Direction. It's Wednesday, March 2nd, 2022, and I'm your host, Justin Nielsen. And I just want to kind of remind you one more time, before we get started on this podcast, I wanted to kind of tell you about a survey that we'd like your help with. If we could have our listeners just go to this survey, it's at investors.com/survey. We want to kind of find out what it is that you want out of this podcast, what investing lessons, what things you'd like us to cover. We want to customize this for you, make it better. So if you could go to that investors.com/survey, it would really help us out, customize this for you, and make it the best it can be. So we really appreciate your help on that. So let's go ahead and get right into it. Arusha Paris, O'Neill Global Advisors Portfolio Manager, is with us once again, as he is every week. Welcome, Arusha. Thanks for being here.
Always great to be here, Justin. Thanks for having me.
You got it. And as our special guest, we have Pedro Palandrani coming back to the show. He is the Director of Research, so he's got a brand new title now at Global X ETFs. Pedro, it's great to have you back on the show. Thanks for coming.
Thanks for having me, guys.
Absolutely. So last time we were on the show with Pedro, we were talking all about the infrastructure bill that was going on, the Build Back Better that was in process. So we'll certainly get an update from him on that. But there's also this Ukraine situation. What is it doing for some of the climate control and all of these different themes that Global X has so many thematic ETFs. So we'll dive a little bit deeper into some of those themes that are looking interesting to Pedro. Of course, we'll also cover what's going on in the markets and some individual stocks and ETFs. So that's what you have to look forward to. But let's go ahead and start out with the market. In today's action, I mean, it was one of those big dramatic days, right? Up 2% or very close on the S&P 500. But I mean, that just seems like it's the norm right now, right? With the volatility we've had. And really, in a lot of ways, we were just kind of regaining the ground lost from yesterday. So what's your take, Arusha, on where we're at in the market?
Yeah, well, we're almost we have to wait for the volume to come in, but we theoretically could get a fall today if the volume is higher than the previous day. Now, it looks like the volume is tracking lower, and so you might just barely miss having a fall today. And a fall today, all it is it's a market signal just letting us know that the market might have a chance to go on a rally here. And so that's what I was watching pretty closely to see if we were going to get over that threshold, both on the price and volume. And so we'll have to wait a little bit longer until we get the official numbers in. But that's kind of the key thing. But Justin, you mentioned the volatility. Now, when you are in harder markets, more volatile markets, you could get some fall through days that fail, right? You'll get a few more false signals. We already had one fall through day a month and a half ago where that failed. And so we'll have to see here. You don't ever want to assume that it's going to fail. You always have to take them very seriously because no bull market has ever started without one.
Yeah, so that first follow through day that you mentioned, that was January 31st. Again, we had come down with a dramatic reversal on January 24th, and then we kind of rallied up from there, had our follow through day. But there were a few things that were working, particularly energy, some of the fertilizers, some of the metals, things like that. But it quickly rolled over and we undercut that and then had another dramatic reversal on February 24th. And now here we are in position to potentially have another follow through day. But we've got that 21-day moving average line looming large, I feel like.
Right.
Acting as potential resistance. So it's almost like, look, you could have the follow through day, and we certainly have more setups this time. So that's certainly a positive. But until we get above that 21-day moving average line, I don't think there's going to be much reason to go, full bore in terms of increasing your investment percentage to, 100% or on margin, heaven forbid.
Right.
So, Pedro, I want to kind of get your thoughts. Broad market. What is your kind of take on what's going on? We've had, really one of the more serious corrections that we've had in a while. I mean, certainly there was the COVID crash, but that was so quick and so violent. This is kind of more your run-of-the-mill correction. What's your take on the general market?
Sure. Yeah. Clearly, we're like you guys said, we're having much higher volatility than we used to have just early on in 2021, and that's definitely threatening high growth stocks, right? Like you mentioned here at Global X, we have probably the most comprehensive suite of thematic ETFs in the market with 34 ETFs. And certainly, we've seen some volatility across multiple areas. These are, themes that tend to have high multiples, high valuations, and therefore, as you are under an environment with rising interest rates, rising inflation, and of course, right now the geopolitical tensions that we're seeing around the world, that's making investors to focus a lot more on earnings growth, on large cap, on profitability, and that's something that oftentimes is not something that you see within thematic ETFs. However, I think it's important for investors to understand that thematic ETFs and thematic related stocks are not always, unprofitable or small cap oriented. Sometimes, you actually have thematic strategies that tend to have higher allocations to sectors such as materials, for example. So if you look at things like lithium and battery technology, most of the stocks within that ETF are within the material sector. So that's something that it's actually benefiting from rising inflation, right? Generally speaking, commodity prices are up. So we're seeing lithium prices up as well. And so lithium miners are benefiting. So I guess that, as a kind of final thought here, it's important for investors to not paint with a brush broad all thematic stocks because of that reason. Thematic strategies are often offering opportunities outside of disruptive technology, as we might think that that's the case always.
Well, and sometimes, I'll be honest, I use some of the thematic ETFs as kind of a gauge of where the strength is. I mean, you can kind of see it in the same way that I'll use like maybe the sector ETFs, the spider sector ETFs, it's kind of like, hey, this kind of just tells you where things are moving. And then you can do that deeper dive in terms of, some of the stocks that are leading that. What's your take there, Arusha?
Yeah, I do. Well, really, my question was also going to go more towards Pedro. Like for Justin and I, obviously, we're going to be using more kind of the action to let us know when to lighten up in certain areas and things like that. So certain themes are going to be definitely in favor versus others. But Pedro, I'm assuming that with these thematic ETFs, because you guys are looking at 5-10 years out, that really kind of just a normal market cycle isn't necessarily going to play into kind of the thinking of the allocation within the ETFs, because it's, as you mentioned, it just kind of naturally it'll naturally balance out where sometimes commodities are in favor, and so the lithium batteries might be doing well where some other higher valuation type of stocks are gonna go through their corrections. Is that thinking correct?
Yeah, absolutely. When we think about thematic investing, generally speaking, it's about providing exposure to macro level trends that, to your point, Arusha, are going to play out over the next 5 to 10 years. So, short-term market dynamics, of course, are important and, of course, are going to impact some of the stocks within these areas. But at the end of the day, if we have a very high conviction in things like cybersecurity or video games and esports or robotics and AI, these are actually good opportunities to take position on many of these areas. We actually, for 2020 and 2021, when many of these strategies were doing very well, we had a lot of investors sitting on the sidelines and saying, well, valuations are very high. Stocks have gone up significantly. So maybe we're going to wait for a market correction. And probably this is a good time to start thinking about, adding some allocations towards thematic strategies.
Yeah, certainly one of the things that Bill O'Neill would often suggest is, certainly with your diversified mutual funds, index funds type thing, corrections are a great time to add to those positions. Now, with thematic, I guess it's a little bit trickier. If it's diversified, you can kind of expect that you're going to get that mean reversion. But sometimes with the thematic, something can be out of favor for a lot longer, and the bounce might take, the mean reversion might take longer. It could have a significant more downside than maybe you're expecting. So I guess that's the trick. Sometimes do you have a loss cutting strategy? If you get in at what seems like a low and it goes lower, what is it? what are you supposed to do, especially with some of these themes where, is something out of favor temporarily, or is something starting to turn into an old technology as opposed to the cutting edge stuff? What's your thoughts on that, Pedro?
Yeah, I think you're right. Ultimately, we agree in that not every single company and not every single theme is potentially going to be a winner over the next 5 to 10 years. So, for investors, we usually recommend an allocation of somewhere around 10% of your equity exposure within a portfolio towards thematic strategies. Again, you're going to have much higher volatility. Your beta is going to be a lot higher if your benchmark is something like the S&P 500 or the ACWI. So, that's something that we acknowledge. However, if you're trying to capture alpha, if you're trying to beat your benchmark, oftentimes these thematic strategies give you that opportunity, right? So things like fintech, for example, have 0% overlap with something like financial services. So it's a diversifier, and if you're trying to capture alpha with all the disruption that you're seeing in the financial services sector, so fintech could be a good opportunity to do that. So, and that applies to every single sector of our economy.
And well, speaking of fintech, now, what is going on with fintech? Because it is getting clobbered. You don't have not just small cap or newer ideas like an upstart or an Affirm. You have some of the larger, more established players like a PayPal or Square. Why is a PayPal or Block, I guess now it's called, but why is a PayPal or Block getting hit by? They're like 60% off their highs. Is there a particular reason why they've been correcting that much?
Well, again, to my initial point, we've seen general weakness on these high-value stocks with, very high multiples for many at some unsustainable levels. I don't think there is any structural weakness. Over the long term, I do think these are actually the companies that could be the winners in what we know as the DeFi world. That decentralized finance buzzword that it's coming up every single day on the headlines. These are the type of companies that are very well positioned. They don't not only offer buy and sell transactions or peer-to-peer transaction opportunities, but they also have verticals within cryptocurrencies, for example, or many other areas. Of course, to your point, Block now with that name is definitely making a huge inroads into the blockchain world and cryptocurrency space. So again, these are really companies very well positioned to capture that DeFi opportunity.
Mm-hmm. And hey, to PayPal's credit, just so you know, I mean, the valuation is no longer as lofty. I mean, it's now 23 PE ratio. It's just above the S&P 500. So, I mean, all you need is a 65% correction, and look, your valuation problems are all taken care of. But one other thing I just want to address before we go ahead and end this segment is is the environment changing? So, Arusha, we were talking on IBD Live today about, you brought up the Bulls Bears and how. Here's that Bulls Bears, and a lot of people ask, well, gosh, the red line is your Bulls and your green line is your Bears. Why is it flipped? Well, this is a contrarian indicator. So tell us a little bit about what your thinking is when we start getting to these extremes and a potential crossover here.
Yeah, and actually, now this I think is like a day delayed. We actually crossed over today, so the bear percentage actually became greater than the bulls. So you had a crossover much like this over here back in March of 2020. And what that's letting us know is that the pessimism has gotten high enough, or the fear has gotten high enough, where too many investors are leaning too far to one side. And this kind of crossover where the bears, there are more people actually more bearish than bulls, happens on this indicator. It's pretty rare, maybe every few years or so. And usually when you get that crossover, it's near a short-term bottom, and there have been plenty of times where it is right near kind of the ultimate bottom. It's not on that day, it may happen the next few weeks, but whenever I see this, I take it very, very seriously. I think I've only seen this crossover in the last 10 years, maybe 5 times, and it's always gone right around there. So it just gives me an idea that maybe we're getting closer. That being said, I'm still using our follow-through day indicator as when to start moving more into the market.
Right. It's kind of letting you know that you're in the proper environment to be ready. It's your warning signal, if you will. So, well, when we come back, we're going to talk a little bit more about some of these thematic ETFs and what Pedro is seeing as the potential leaders of the next cycle. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Okay, welcome back, everybody, to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, your host, along with Arusha Paris, my weekly special guest. And the even more specialer guest is Pedro Palandrani. He's the Director of Research at Global X ETFs. So, Pedro, last time you were on the show, we were talking about the infrastructure bill. That 1.3 trillion had just gotten passed, and we were looking at the Build Back Better. So there was a lot of this infrastructure talk. Let's just kind of revisit that. How did that play out? I know that there was some of the legislation stalling. How did that play out? Like you thought, or are there adjustments that you had to make based on the reality?
Yeah, well, clearly we got that $1.2 trillion passed in the House in November 2021. Actually, in 2022, we're already starting to see some of that budget being spent by some federal agencies. The largest one that comes to mind is from the Federal Highway Administration. They're planning to invest $52 billion in 2022. Now, important for investors, most programs funded by the IIJA, the Infrastructure Investment and Jobs Act, are long-term projects. Most of them are actually projects that are going to start happening in the mid-2020s. In fact, we're estimating that around 51% of that spending it's going to happen by 2026 and about 90% by 2031. So this is, again, a decade-long type of spending plan that we're going to see in the infrastructure of the United States. Now, just last night, we have Biden talking about infrastructure, and he actually mentioned that infrastructure in the United States is ranked 13 in the world. Right. So that's something that, it's clear that we need to improve. It's clear that we need to invest more money. He actually even said that, we're done talking about infrastructure weeks. We're going to have an infrastructure decade. And this is really how we see this thing playing out in the future. It's not only about kind of the short-term dynamics, it's about the long-term. 43% of the roads in the United States are in poor condition. 9% of the drinking water systems serve 80% of the U.S. population. And 70% of U.S. transmission lines are at least 25 years old. So we clearly need to invest in infrastructure. Short term, there are going to be some inherent volatility just as it's happening across the equity markets. Commodity prices are going up, so that's negatively impacting some of these construction opportunities. However, again, over the long term, I think this is one of those trends that are clear that we're going to have some winners in the space.
Yeah, and just taking a look at PAVE, maybe Arusha, maybe you could put that up real quick. That's the Global X ETF infrastructure, U.S. infrastructure. PAVE is the ticker symbol, just so we can have a look at that for folks that are watching the video.
Yeah, and you can see with PAVE, it's getting back above the 200-day, getting through a little bit of resistance there, and so maybe it's setting up to move higher. So this is a good one to keep an eye on. But I mean, I pulled up United Rentals too, where this is well poised if all this money is going to go in there and really start even more construction, because they're renting out a lot of this equipment that's needed. And this has been struggling for a while, but it looks like it's trying to it's back above the 50-day moving average, trying to get back maybe over the 200-day in the next month or so. And I also noticed the relative strength line starting to get above its little moving average right there too. So yeah, so Pedro might be right here, where now the markets might be starting to adapt to what the President Biden was saying.
And so, Pedro, do you, again, because this is a decade-long thing, sometimes what happens with the price, I feel like there's almost like that initial hype, when all of the legislation was, coming out and the prospects, and so now. Again, there's still a lot of funding that's going to be coming out over the next few years. So is this kind of pressure? And again, putting it in perspective, PAVE is down, less than 10% at this point, and the markets are down a lot more. So PAVE has held up relatively well. But again, how do you kind of look at this when you get that initial hype that kind of drives the prices higher, on the news? And then, you've got decades long in which this is going to be kind of playing out. How do you kind of reconcile that?
Yeah, it's interesting because for all of these policy-driven themes, not only infrastructure, but also you have things like cannabis, for example, you get that hype cycle where, the policy is coming. We know that a lot of capital is going to go into the space, but investors tend to have sometimes a myopic fixation in the short term. However, again, whenever we get these policy shifts, these are themes that are going to really, disrupt the landscape over the next 5 to 10 years. And this is, again, what's going to happen with infrastructure. However, already we're seeing capital going into the space. Another project that comes to mind is the improvement that we're seeing in the Port of LA. As of January of this year, we had over 100 cargo ships waiting to enter the Port of Los Angeles. And, that's a record high number. We've never seen something like that. The DOT actually awarded around $250 million for expansion projects of ports just last December. So already we're seeing that capital entering the space. Companies like Jacobs Engineering, for example, just got awarded a contract to design the expansion of the Denver International Airport, that expansion project that it's, again, multi-million-dollar project. So a lot of the companies that you see in PAVE are starting to see this budget entering into the space. And again, something that we really expect to play out over the next 5 to 10 years.
Mm-hmm. And for those that are wanting to look at Jacobs Engineering, the ticker symbol on that is J. And I also just wanted to mention real quick, thank you for correcting me, because I did say 1.3 trillion and it was 1.2, but what's 100 billion among friends, right? Go ahead, Arusha.
Well, I think we should talk a little bit about cybersecurity.
Absolutely.
Now, we know with Russia, before Russia attacked Ukraine, they first had they attacked them in the internet, on the web, and tried to knock out a number of their systems. And even a third party like Anonymous is attacking Russia. Well, all these young programmers, or anonymous programmers, are kind of getting together, and they're trying to destabilize and impede Russia from doing what they're trying to do. So how is cybersecurity playing a role in this? And are you seeing more of a demand go over the next 5 to 10 years for these companies involved in cybersecurity?
Yeah, all of this situation is essentially bringing to the spotlight the rise in cyber attacks, and especially, Russia. Apparently, it could be some retaliation from the sanctions that we're seeing from the Western world, and that could spark a wave of cyber attacks on Western institutions. Just over the last few hours, we've seen many articles around or citing that banks are a major target from Russian cyber attacks. So there's going to be a lot of investing in cybersecurity solutions. For the average person, the risk of a cyber attack is very low. Of course, there are a lot of phishing attempts and all of that, but that's not the case for the federal government, right? And we've seen like the current administration continues to focus significantly on protecting organizations and institutions within these critical areas within our economy, right? So financial services, utilities, energy, food, all of these are critical part of our supply chains. Just in 2021, if you guys recall, we had the Colonial Pipeline cyber attack. We had the CNA financial ransomware attack, where that financial institution paid around $40 million to decrypt parts of their digital infrastructure. We also got the JBS cyber attack. That's the largest meat producer in the world. So a lot of cyber attacks happening in critical parts of our supply chain. So clearly, this is commanding greater investing in cybersecurity solutions, and that's why we're so bullish on cybersecurity in 2022.
Mm-hmm. Now, okay, you were saying earlier though that certainly a lot of these highly valued stocks, the high PEs, the richly valued, heavy growth, were some of the stocks that were out of favor. But man, computer software is full of those. Computer software security, even. You look at Zscaler, CrowdStrike, Palo Alto, Fortinet. I mean, they almost all have triple-digit PEs, well above the S&P 500. So, and as you mentioned, we already had kind of all of these cybersecurity concerns even before the whole Russia-Ukraine thing. This is just, I think, bringing it even more to the forefront. So, given that you have on the one hand the out of favor, highly valued stuff that is in the cybersecurity, but also this big catalyst, really. Again, how do you reconcile those two things? And maybe, Arusha, for those that are watching the video, maybe you can put on the Global X ETF bug, which is the cybersecurity. Is that the best one to show here, Pedro?
Yeah, absolutely. Yep. That's our cybersecurity ETF. It's actually one of the best performing funds that we have this year on our thematic suite, and maybe Arusha can comment on that. But you're right, Justin. It's one of the high value sectors or segments within our economy. A lot of cloud computing related stocks, a lot of SaaS related cybersecurity companies. But number one, you have a lot of tailwinds coming from the government level that's spending a lot of money on cybersecurity. Corporations alone are expected to spend $172 billion in 2022. And even us as consumers, we're also keeping an eye on cybersecurity solutions. Now, why we like it so much, fundamentally speaking, is because the business model of cybersecurity stocks is very, very attractive. Again, most of them are software as a service platforms. And what we're seeing is that the net dollar revenue retention rates in most cases for cybersecurity stocks is above 100%. So this metric basically is the beginning of the period revenue for a cohort of clients, plus any upgrades minus any downgrades, all of that divided by the beginning of the period revenue. And if that formula yields a number greater than 100%, then you're essentially saying that the growth from that cohort of clients or from that customer base more than offsets any losses from that same customer base. And that's what we're seeing in most cybersecurity stocks, net dollar revenue retention rate above 100%. So these companies are growing not only from upselling new solutions to clients, but also onboarding new clients. So very, very attractive business model here.
Yeah, I pulled up the chart of bug on MarketSmith, and really over the last week or so, you have a lot of volume coming in. It's gotten back above its 50-day and 200-day moving average, and so it has a real chance here to build the right-hand side of the base. And I also pulled up the holdings page right here, and so Justin, these are the top 4 holdings in bug. Checkpoint Software, which is
I've heard of them.
And it's been a rocket ship.
Jason Thompson was just talking about them on IBD Live last week.
Yep. So Checkpoint Software, Palo Alto Networks, Fortinet, and Norton LifeLock. So all 4 companies on a stock basis are doing really, really well. Now, Checkpoint Software has over 8%. It's over 8% in this ETF right here. So Pedro, how does that, are you just letting kind of the market and the stocks that continue to do better and better, they just become a larger and larger percentage of the ETF? Do they all kind of start equal, or is there kind of a conscious decision to put a little bit more weighting towards a Checkpoint versus something else?
Yeah, great question, Arusha. So essentially, most of our thematic ETFs have a weighting scheme of market cap or a modified market cap. So essentially, we're allowing the winners in each of these themes to have a higher allocation within our portfolios and the losers to have a lower allocation. So if you think about that relative to another strategy that follows an equal weighted approach, that strategy is going to end up selling the winners and buying the losers at each rebalance and reconstitution. So that's a very anti-momentum strategy and a very momentum-driven strategy. So that's why we're so focused on that market cap weighting scheme that essentially allows the winners to continue to have a higher allocation within the portfolio.
But now you mentioned a modification. So go ahead and why don't you speak to that modification?
Sure. So essentially, that speaks to the fact that sometimes we cap the initial weight of each security, say to 6%, for example, or 5%. It really depends on the theme, but we're capping that initial weight. And the reason why is that, you tend to have themes like e-commerce, for example, where if you were to just allow the companies to have a weight on a free float basis, you would end up with Amazon being 50% of the overall e-commerce portfolio. So we don't want that. We want diversification. We want to make sure that we're providing exposure to the universe of leading companies in each theme. So that's why we have that modified aspect to the market cap weighting scheme.
Yeah, very good. And so are there any companies in particular? I mean, Arusha just went through the top holdings, which again, IBD listeners should be very familiar with those names. Are there any of these companies that particularly stand out to you as having a competitive advantage, especially with maybe the higher level, the government level?
Sure. So one of the companies that I like the most is Zscaler. Again, this is a 100% cloud computing a cybersecurity company. So again, everything is kind of software as a service related. And one of the offerings or solutions that the company has is called CPA. CPA essentially provides users with access to internal apps without the need to connect to the network of a company. So, right now that we're working from home in many days of the week, we tend to connect to the company network through a VPN solution. So the VPN allows you for access to the overall network with a few privileges from time to time. However, zero trust solutions like the CPA solution from Zscaler essentially eliminates the trust within the network. So no one within the company can have access to the overall network. So if you actually have a cyber attack, that prevents that cyber attacker to move horizontally through the network. So, Arusha, if you get a cyber attack and that moves over kind of, the network and that impacts Justin with VPN solutions, that's not going to be the case with zero trust solutions. So essentially, these type of solutions is going to, reduce the use of VPN solutions over the next few years, and one of the reasons why we like this company so much.
Sounds like a game changer. Well, when we come back, we're going to talk a little bit more about some of the thematic ETFs that Pedro is doing his research on and some of the stocks that are driving them forward. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back, everybody, to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with Arusha Pires and our special guest, Pedro Palandrani from Global X ETFs. So before we move on to some other themes, I want to just kind of real quickly jump back to infrastructure. We talked about URI, United Rentals is one of the stocks, but Deere is another one that Arusha wanted to mention. So Pedro, can you give us your thoughts on Deere, the ticker symbol DE?
Sure. Very attractive company from a valuation standpoint. 21 times earnings, as I see in my screen right now. This year, where a lot of investors are focusing on that quality growth side of things, this could potentially be a good company. From a technology standpoint, leading in many ways on the agricultural side of things. Just early this year at CES, they introduced the first fully autonomous electric tractor, and that's going to be for large scale production in agricultural fields. So that's going to be quite of a disruptive technology for the agricultural world. That actually, if you look at some of the videos, you can see how the tractor can be controlled through the smartphone. So it's very interesting technology and something that we believe is going to help reduce emissions and operating costs for farmers, as well to as allow for improved yield. So ultimately, ag tech is all about maximizing inputs and minimizing actually the other way around, minimizing inputs and maximizing output. So that this is a company that within the ag tech and infrastructure ecosystem is going to be leading for many years.
Yeah, I pulled up the weekly chart of Deere and had an amazing 2020, and it spent most of 2021 going sideways. If you can get past that 400 level, it might have a chance here to start moving up again. So technically, it's acting well. It's finding support in all the right areas. It got through earnings, and and as Pedro highlighted, it has some leadership qualities from the fundamental side and some interesting growth catalysts.
Yeah, you look at that weekly chart and you're like,
Yeah.
wait, that's Deere?
Yes,
Like,
exactly. Yeah.
that's not a tech stock. So, kind of in a almost related way, we were talking a little bit at the break about the whole video game idea, and of course, metaverse was really on everyone's mind. As Facebook changed their name to Meta, and everyone was talking about that. So maybe you could talk a little bit about the infrastructure of the metaverse and what that's going to be doing to the video game industry.
Sure. I think for investors to better capture the metaverse opportunity initially or within the early innings of the metaverse is going to be through infrastructure related companies. Infrastructure, I mean, the companies that are building the augmented reality, the virtual reality, the mixed reality technology. In a few years, we're actually going to even see haptic bodysuits, omnidirectional treadmills, brain sensing wearables that can control the immersive experiences that the metaverse requires. Because let's be realistic, for a metaverse to actually work, we need very immersive experiences, and that can only be accomplished through hardware related technology. So once that infrastructure is in place, we're actually going to start focusing a lot more on the content side of things. So who are the platforms, who are the companies that are very well positioned to benefit on that content side of things, that are going to offer very good experiences for the users. But first, again, it's going to be on that infrastructure side for the metaverse
and at the hardware.
Yeah, and I think that's a great point, Pedro. Now, I pulled up Roblox here because Roblox is one of those key players in the metaverse, and they almost have their own. They do have their own closed ecosystem. What are your thoughts on a company like this? Even though it is still a number of years out before that whole infrastructure gets becomes a reality. What are your thoughts on a Roblox since it went public in the last year?
Yeah, I think it's a really, really attractive company and potentially one of the companies best positioned within the content side of things for the metaverse. So, 1 in 2 kids here in the United States actually play Roblox. They have over 40 million daily active users. That's a very large number. What I like about them is that they have this ecosystem in place of developers that are actually getting paid by developing these, thousands and thousands of experiences within Roblox. They also, of course, have the users, and they even have these economy within the in-game experience with their own currency, the Robux. So, this is a company that is really well positioned to benefit from the new idea of video games as a new social media outlet in our society. This is a new way for people to collaborate, to play, to learn with friends and family all around the world. So that's the new attractiveness of video games, is that social aspect of things. In fact, if you look at every single successful video games over the last few years, it has had that social aspect as kind of the main driver of the success of the title.
Mm-hmm. So we're kind of waiting, I guess, in terms of the content for the metaverse, until some of that hardware comes on, and it might be worth looking at the Global X ETF Hero, HERO. That's the video game one, right? That we're kind of talking about. So are there other, I guess, since the metaverse is maybe not quite ready yet, what are you seeing now in terms of what's happening in video games? What's exciting there?
Sure. So, first of all, a lot of M&A activity. You probably saw Microsoft acquiring Activision Blizzard for a massive cash-only transaction. Take-Two also going through some M&A activity. I actually think that, Amazon could potentially buy one of these large video game developers and publishers. Amazon has been in the space for about 8 to 9 years, the video game space, and they have had 2 video game launches. The two launches failed completely. So I'm really sure that they're going to be trying to enter the space more seriously with a lot of capital, and that could potentially be through some M&A activity. What I like right now is not only that social aspect of video games today, but also the improving business model of video games. 10, 15 years ago, for us to go buy a video game, we used to go to, the nearest Walmart or GameStop to buy the video game hardware, right? The CDs to play that video game. That's not the case anymore. Over 85% of video games are distributed digitally. And that essentially means that video game developers and publishers are leaving aside all the nightmares associated with supply chain. So they don't need to manufacture those CDs anymore. They can just deliver the video games to the end consumers via digital distribution. So that's really making these companies improve their gross margin profile. So that's just one of the things that we really like today from video game companies.
And Hero here has been kind of in a downtrend. Again, is this more because of the richly valued companies, or is there a catalyst that you think can kind of turn things around here for the bulk of these games, these gaming stocks?
So I think we've seen a little bit of weakness associated with the fact that, people are starting to go out. 2021, 2020 were periods where we were at home, nothing to do outside in the world. So right now that's changing. So engagement in video games are declining slightly. However, like I mentioned before, the fact that these are the new social media channels in our society offers a good long-term opportunity for video games. Improving business models, new forms of revenue. Right now, video game companies do not only monetize from buying upfront the video game, but they actually continue to monetize their user base by introducing, new downloadable content like new maps or new weapons or things like that, but also microtransactions. So if you want to wear some sort of, Nikes or Adidas shoes, you can actually do that right now in the video gaming, and that continues to improve the monetization for video game platforms.
What about mobile gaming? I was pretty surprised to see how large the revenue from mobile gaming was versus console gaming.
Yeah, we're talking, again, generally speaking, the video game industry is probably about $180 billion in annual revenues. Almost half of that is from mobile gaming. And that's essentially because there is a low barrier to entry to mobile gaming, right? Everyone around the world almost has a smartphone on their hands right now. So that's a very large market, very large opportunity. You can think from video games like Candy Crush, from Activision Blizzard, and other kind of newer video games that you can also play on the mobile setting. But just the fact that it's such a low barrier to entry is making that sector to be such a high share of total revenue generated in video games.
Mm-hmm. So let's go ahead and shift gears a little bit to round out the conversation. Certainly one of the things that we've been seeing really dominate this year is energy. Of course, oil and gas predominantly. We talked a little bit about materials and all of these inputs that have been costing more. Mining and stuff. So let's talk a little bit about what with the situation in Ukraine and what's going on in Europe and their dependence on Russia for a lot of this stuff. They've for a long time, Europe has been looking elsewhere for the renewable energy, the clean tech, climate change, trying to get that solar, that wind. Now they have more of, I guess, a motivation to do so, just to get off that Russian oil and gas. So talk a little bit about what you're seeing in the climate change space and what companies might be worth looking into right now.
Sure. Actually, over the last week or so, many of the companies within the solar and wind renewable energy production are up over 20%. So companies like SunPower, Sunrun, Enphase, Ørsted in Europe, Nordex, all of these companies have surged in price, basically because, like you say, the world is now increasing the demand for renewable energy and try to decrease the reliance on oil and gas. And Russia is such a big player in that camp, and we know that there's likely a prolonged geopolitical tension there with Ukraine. So investors are recognizing the opportunity within the renewable energy space. This is not only going to be driven by this situation. Again, this is one of those short-term shocks to the economy that happen to favor climate change-related stocks. But over the long term, we know we're going there. We need to get to net zero emissions. We need to get to solve a lot of the climate change concerns that we have in the world. And climate change-related stocks are going to benefit from that.
Mm-hmm. Arusha, go ahead.
Yeah, I was trying. Well, should I pull up Raise?
Which one? CTEC, Raise? Which one would be the best one to kind of start with?
Yeah, Raise is our solar ETF. We also have Windy, WNDY, our wind ETF, or RNRG. That's our renewable energy ETF that encompasses a variety of multiple renewable producers from the solar, wind, and a few other areas of energy production.
Mm-hmm. So you mentioned a number of the solar companies, and I think a lot of people are familiar with those because they had such a run before. What are some of the companies and some of these other, like the wind or the renewable energy? What are some of the companies that are interesting to you in those spaces?
Well, Sunrun is an interesting company. Like I mentioned, it was up significantly over the last few weeks. Today, I think they're having a negative day, down 5%, probably showing some correction after that nice run. But what we like about it is that they're the number one residential solar provider here in the United States. So it's one of the companies that, as you continue to see greater adoption from the average consumer, they're going to continue to benefit. So consumer behavior is changing favorably towards renewable energy production, and this is one type of company that could benefit from that residential side of things from solar energy.
What about so when a lot of people are putting up kind of the solar panels and things like that, capturing that energy, are there a number of companies coming out with kind of the batteries that, because I know like a Tesla has their like battery that you can put on the wall. Are there other companies coming out like that to compete in that space?
Kind of the storage?
Yeah, exactly.
So yeah, to your point, there are times during the year or during the days where the wind's not blowing and the sun's not shining. So energy storage is definitely key to support that transition towards renewable energy. Companies that come to mind are the leading battery technology companies. So you have LG Chem, you have Panasonic, you have CATL in China. All of these companies are growing primarily for the work that they're doing on the EV space, because they're working with most of the leading EV companies around the world. However, kind of the secondary business vertical tends to be that energy storage solution. So again, Panasonic, LG Chem, CATL, all of these companies are well positioned to capture that opportunity.
And speaking of Tesla, well, I do own shares of Tesla, but how is Tesla competing like in kind of the solar space? Because they acquired, I can't remember the name of the solar company.
Was it Solar City?
Solar City, thank you. They acquired that, and they do have some plans to kind of put the solar panels on the roofs and stuff like that. Are you seeing
There's
any
a Tesla
kind of
roof just down the street from me?
Is there?
Yeah, it looks sharp.
They look cool, yeah.
Yeah, they're going to, I wouldn't call that it's going to be a major driver of the Tesla stock over the next few years. I would say that, Elon Musk has said that side of the business, the solar side, it's going to be larger. However, when I look at Tesla and when I look at the future of the company and what are going to be the drivers, I think more of the AI side of things around autonomous vehicles and all the data that they're capturing with their cars and the cameras that they have on the Tesla vehicle. So, again, if I were to focus on Tesla, I would be looking much more at that autonomous vehicle side of things, which, by the way, they publish a quarterly safety report. If you look at that, Tesla's vehicles that implement full self-driving technology are 10 times better driver than humans, which is a mesmerizing fact that we just came across. And it's something that it's been sustained over the last few quarters. So again, 10 times better drivers than the average human, just measured by the number of crashes that you see on those vehicles.
Very interesting. Well, any final thoughts, Pedro, before we wrap this up? I mean, you talked a lot about a lot of different themes. Any kind of overarching advice for investors right now?
Well, the world is facing tremendous disruption across every single sector of our economy. And I think we as investors, we should position our portfolios and to capture those opportunities, or essentially to future-proof our portfolios. And, thematic investing really offers that type of opportunities.
Wonderful. Well, I really appreciate you coming back on the show, Pedro. It's always a pleasure talking to you, and I'm sure we'll have you on again soon.
Thank you.
Okay, that'll do it for this show. And on the show next week, we're going to have Anne-Marie Bain. She's been on IBD Live, a great discussion that we've had with her on options. She's the author of the trading book, very knowledgeable, always great to talk to her. So we're excited to have her on the podcast next week. So make sure you tune in for that. Thanks for watching. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.